Hi, this is David from Enzo Trading System, and today I'd like to do a quick update and answer some commonly asked questions, which they're really quite common, and I think they definitely deserve a deeper explanation than what I can generally do in a quick answer. So first thing I would like to do, give an update on things. We did update something around the algorithms. It's something that we do every few months. Specifically, we worked on the updating the machine learning training parameters. So basically how the algorithms get selected. They're a bit, oh, where is it? Yeah, they're a bit better right now. They would have been better in May. Of course, still not ideal, but there's really nothing that we can do in this market. And yeah, definitely I'll spend a few words on it. But for now, there's basically nothing but having to wait for the market to unlock either the upside or the downside. So this update definitely would have helped in the recent months. Hopefully will help also in the future months. As usual, this kind of stuff, the main algorithms, the main indicators, they're pretty much the same, but there are some things that we adjust as we get more market data. Usually we do them every 3 or 4 months because continuous change it's not ideal, and it really needs to be done sparsely and really with purpose. So hopefully from now on things will be a bit better, but we'll see. So about recent market, yeah, we're still in a drawdown. We had quite a string of losses right now, and I think this is it can be worrying if somebody especially using leverage like 4x or 5x, even 3x can be quite scary. So I would like to first spend a few words actually on the issue of risk management, loss and profit, and then after that I will actually go and answer the big question, which is should we unplug the trading? And I'll tell you right now, that's not what I'm going to do. I think I personally I think is the wrong thing for our system, but of course everybody is entitled to make their choices, their money, so by all means. So yeah, on the losses and risk management, I think especially with the leverage, it's very easy to get into the mindset of extrapolating linearly. So one sees like losing, high leverage, you lose 60, 50%, and then into the mind is like, okay, I had $1,000, now I have 500. It's been like a month, so next month I'm gonna have 0. So therefore, I mean, I'm a downfall, so I'm just gonna pull the plug. Yeah, it doesn't really work like that. The losses are managed by the management, the risk management, which it splits into smaller losses. So what happens is it's not linear, but it's a power curve. Let's say that this red curve here, it's a sequence of the fund that starts at like $100, and it will go down. It will go down by 50%. Assuming here it's totally made up numbers, just for purpose of explaining. But let's say that every loss is 2.5%. So of course, this doesn't take into account leverage or separation between. It's just up to simplify. With 2.5% after a string of 27 losses, then one will reach 50%, and then it will take a lot more losses to actually even get closer to, let's say, 20%. So being a power curve, you don't really, I think, normally one starts to think in a linear fashion and thinks that it's going to crash into it. But actually, as you lose more and more, you're going to lose. As you lose more often, you're going to lose less because you have less to lose, basically. And that's the gist of the risk management as far as utilizing stop losses. And it's actually how our system works. It's built to take a lot of smaller losses, even if they may not seem small, and then make the bigger profits in very sparse, very rare trades. And so on the green side here, this would be profit. We'll take about, assuming that one makes a 5% profit for each trade. Of course, it's never happening in a sequence. But in general, we take the idea, we take a lot of smaller losses and a few big wins. And so let's say after 8 wins, you're already up by 50%. After 14 wins, you're up by 100%. So that's the idea. I mean, this is very stylized. It's very abstract, but I think it could be also another interpretation. That the important thing is looking at the power curve, both in the loss, which is softened, and actually in the profit, which is actually sped up. This is accumulation in a positive way and in a negative way. So that's kind of the gist. I mean, I probably doesn't explain it really well, but it could be just something that helps into explaining it. So what should we talk after this about? So yeah, I mean, pause it or not. I mean, and this is very common questions like, oh, the market is going down. It's been going down for a month and a half, 2 months, and it's not looking good. We are in a bear market, maybe. I mean, it depends how you define bear. So I'll unplug during the bear market and I'll plug it back during the bull market. Unfortunately, I mean, this would be nice, but it's not as easy. Otherwise, everybody would do it. What really happens? The system, to explain it, it is a statistical system at the core, but there are basically 3 levels at which we have an edge. At least we attempt to have one. The first level is that at the smaller level, we have an indicator that gives a trend. This is not a linear trend, so green would be buy and red would be sell. But let's say it works in general. It may not work for a while, but it will work in general. That's the point. The second level is the selection of the algorithm. I don't have a graphic representation of this, but this would be the name of the algorithm in the current score, which thankfully is positive. This happens every month, every 2 months, 3 months. It really depends. And an algorithm and its permutations is selected depending on the score based on the market. So that's kind of a time-based adapting systems. Then at the highest level, which is possibly the most important, there is the statistical consistency of the system, which tells that there is going to be a certain frequency of wins and losses, but it is not clear when. So this is because in the long term, it's really not possible to predict the market. A lot of people will try with technical analysis. They will draw a line. They will say it's going down, therefore it's going to continue to go down and all this. Frankly, I mean, give me 1,000 technical analysis or whatever they're called, and I'll give you one that gets it right 10 times in a row, but it doesn't mean that he has a special technique. It's just everybody's gonna have a luck and get a good streak, but it's not reliable because as you go further and further with prediction, you have less and less ability to predict things. This is not just the market. I think an example that I like to do is that of predicting the weather. Yeah, we have the technology to look at whatever cloud formation is in the sky or what's the pressure of the air, and we can tell like, okay, maybe tomorrow is going to rain, but that's it's relatively limited set of data. As you go further and further with the attempt to predict the timing of events, it really is a chaotic system. And this is true for the weather prediction, and it's true, I mean, anything in physics that is represents a fairly complicated system with a lot of variables, and the market is one such thing. So, but in weather prediction, yeah, we can't tell, you know, 1 year from now if it's going to rain or not, but we can tell that we're going to have, let's say, 60% days of rain and 40% days of not rain. So that's, you know, and this somehow it can be translated into any kind of a statistical prediction. In this case, it would be market. So we can't really tell, and honestly, I don't think, you know, virtually anybody can really tell where the market is going to be in a month or even a week. But we can tell that by applying a certain system that is attuned on past data, which is fairly representative of, you know, unless the market really goes wild, but, you know, if the, you know, the world flips over and there's a World War III, but that's generally not the case. Unless anything really crazy happens, then you can pretty much predict. And I mean, even if in general, anything crazy usually translates into massive dumps of the market or pumps, and that's actually not so scary, because a dump, it's fairly easy to manage, and then we're really happy when there's one. You know, you can see here, yeah, you close and you know, you can save a 13% all the way down, because, you know, stop loss kicks in. The problem is really when the market is unpredictable, and this is a, you know, it's called an accumulation phase. It's not going to last forever, but it happens every year, several times during the year, and all we need to know to have a certain degree of certainty that we can make a profit is that these things are going to happen. They're going to last, okay, long, and we're going to take losses because it's uncertain. You don't, you know, you keep trying and hoping to get a big win, but you can't. And so why shouldn't one pull the plug? It's really because it's unpredictable. And some will say, okay, this is a bear market, I'll pull it. I'm fairly confident that it's going to be bad anyway, so I'll pull it back. I'll put it back when the bull market comes in. But bull market may not come for a while. And in fact, there is money to be made also in a so-called bear market. The problem right now is not that we're in a bear market. The problem is that we are in an uncertain market. The moment in which volatility really increases, and even if it keeps going down, there will be bounces, and that's also a place where one can make a profit, and actually one, you know, place where one should attempt to make a profit, because if you leave that potential profit on the table, at the end of the year, you're not going to have that profit. You know, usually, I mean, if, you know, people will take a string of losses, will, you know, lose 50, 60%, 70% with the high leverage, and then pull the plug right now. And then what happens is that you may take a while until you think there is a bull market, then you start trading again. Then perhaps it wasn't a bull market because there's going to be a lot of false positives, and it will be okay. I'll trade a little bit. You'll take a few losses. You'll be scared, and then you unplug the plug or whatever again, and so on and so on. So it's, I mean, I understand at the intuitive level it makes sense, but if it was so easy, you know, everybody would do it. And in fact, everybody, I mean, a lot of people do it, but that's why a lot of people lose money. So, but at the end, I mean, everybody has to make their own choice. But I think, I mean, I just wanted to explain why I say that the system, it's important that stays running for at least 6 months, because there is very rare profitable events that one needs to be ready to take advantage of. And you can't really predict when it's going to come. You know, maybe tomorrow we're going to make a plus 10%, plus 20%. Okay, it's unlikely, but it's possible as well. So you always want to be in the market so that that opportunity you won't miss that opportunity. I don't know, it's counterintuitive, but that's why it's difficult to trade. So that also explained the losses. So I would like to talk about leverage. I spoke about this before a while. I think I actually made a chart that is a little bit okay. This is not realistic. It's really abstract. It doesn't show how accumulation works. It doesn't really show how leverage works. But at the very abstract level, I think it may give an insight about what is happening with leverage. And that's, it's not about risk management. Risk management is this one, and it tells that the loss is not linear. So fear, but also, fear is important, but one also has to take into account what is really going on. That there's risk management in place that prevents total loss. So here I have a little very simplified graph that shows ideal line of profit starting from the beginning of the year, ending at the end of the year, 365 days, and with 100% profit. And related to last year, we did 120 unleveraged. And here is what may, in a very abstract way, what are the fluctuations happening. So depending on the phase of the market and the performance of the algorithms, one may quickly reach like 27% after a month, but it may also end up at minus 16 another month later. All the while though, the phases, if one can ignore the phase, there is actual profit curve that is on the upside, ideally. This down phase may take a few months, but statistically, this profit curve needs to be solved in a certain projected profit based on previous experience and a certain degree of confidence. I've shown this before, and I can show here also. Let's say this would be my nice linear profit curve, but in fact there are going to be all these drawdowns, and that's really what happens. But long term, that's where it's supposed to go. Maybe not as high, but in the meantime, there are those fluctuations. And now related to leverage, now I'm going to simulate my very fake leverage. But let's say now we're fake leverage 1, end of the year 100%. Now we're fake leverage 2, end of the year 200%. Again, this is fake because the leverage 2 it would be more. But and also fluctuations will be different. But now, the fluctuations are quite marked. Let's say that I'm on a leverage 4. I may, get lucky, get into right after a month plus under 60%, but then next month minus 65%. But all the while, we're working our way up, hopefully, into 400% at the end of the year, maybe 200% at the middle of the year. So, but these fluctuations there, I understand that they are hard to deal with. You're plus 200% and suddenly you're like as if you didn't make any profit. And this is actually, the cost of leverage. The cost of leverage is that of actually opportunity cost in a sense, meaning that you may not have that amount of money that you need in your fund, when you need them. And that's why I say leave it there for a while, especially if you have leverage, because if you at any given time you can't really rely on a high leverage fund to give you back. If let's say you put $10,000 and suddenly you know after 6 months you have $100,000, now you want to buy a house, but then as soon as you you keep trading, of course, because you want to reach 200,000, 400,000, but as soon as you ready in the practice, you get a crappy month like we had right now, and suddenly you have $30,000. This can happen, so you can't rely on that. If you can deal with the cost, the opportunity cost, the lack of availability of the funds, and then high leverage may be good for you. And also there's also the psychological issue. I mean, I won't lie, it scares me as well when I trade high leverage. In certain funds we have quite high leverage. One day you're kind of rich, so to speak, and then next month not so much, and then 2 months later maybe you made up, and you're it's a roller coaster. And the only thing that I think it can come as a comfort is that perhaps looking at how it's basically supposed to be in an abstract way. There are going to be fluctuations, and loss is not linear. It is following a power curve. So is also profit. So profit is also going to skyrocket as soon as a series of good trades come, which means bull market will facilitate this, but it's not just bull market. Good trades may come frankly randomly, and that's why it's hard to trade. So I hope I talked about everything. It's probably longer than I wanted it to be. I don't know. I'm as usual available on Discord, or perhaps email if you're if you're working with us. If you have any specific requests, you can leave a comment in the video. I hope this cleared a little bit the inner workings of our system. What's a statistical model? Why you can't just pull the plug, or but of course you can you can do it. It's your own fund, you manage your own fund, but why isn't compatible with our model, with the statistical model? Why that concept isn't compatible? And the risk management, at least in broad terms, as far as managing the losses and the fluctuations of leverage. So hopefully we'll start getting some good trades again. This is I just want to remind, last year similar things happen. String of losses, 1, 2, 3, 4, 5, 6. It happens. This year, of course, we're operating on 4 markets at once. 4 markets at once. So 6, maybe you may get like a string of 24 losses. But that's what happens. It's definitely non-linear. It's not because you had 10 losses now, then you're gonna have another 10. It's actually because you had 10, possibly now you're supposed to get something good, because you can't go in a negative way forever. So I'm rambling. This would be it. I hope it was it clears some of the commonly asked questions, and until next time, have fun and try not to be too worried.